What's going on, guys? Mike here, and welcome back to another video. So today's topic is building a hypothetical $300,000 dividend portfolio. Now, yes, I did say hypothetical $300,000. I didn't win the lottery or come into some large amount of money, and I'm not changing my current investment strategy, but I have been asked a number of times on Reddit as well as YouTube on what I personally would do if I were to build a dividend portfolio. So the key word there is what I personally would do. You know, everyone's situation is always going to be different. So this is what I would do if I were to build a dividend portfolio today. So before we get into it, I do want to just quickly highlight the goals of this particular portfolio. And that is the following. I want 4% annual dividends with a 1 to 2% capital appreciation. So I feel it's very important that the dividends that we're going to be living off of in this hypothetical portfolio is not going to erode away the capital or the portfolio's net worth. So I really want to say that, like, if we were to live off of this portfolio for 5, 10, 15, 20 years, you know, if at that point we were to go to sell it, that portfolio or that $300,000 would have actually slowly grown over those years while living off of the dividends. Now, you could definitely have an increase in dividends, 5 to 6%, and that portfolio maybe stays stagnant or maybe drops ever so slightly. But that's all fine. Again, me personally, this is what I'm trying to achieve out of this portfolio. So if that interests you, definitely stay tuned and let's just kind of get right into it. So starting things off with on my Excel sheet, you'll right away see the number here, $300,000, because like I said, that's the number we're going to be using today as to what we're hypothetically investing. Now you'll see the nice big black blob here, and that's the ticker symbols that I have hidden, and I'm going to be just kind of revealing one at a time so I can kind of explain the rationale behind each ticker symbol. So starting off with the first one, we're going to be looking at the Horizons Equal Weight Bank ETF. So why banks, right? I did a video on banks at a very high level, but the reason why I really like the banking sector for a dividend portfolio, specifically Canada, is that they are very reliable. Now, that doesn't mean that they're resistant to all the downturns or anything like that. TD Canada Trust, a couple of years ago was at $102 a share and dropped down to 80. So they're not bulletproof by any means, but their dividend payouts are on the very reliable side. And we're going to just quickly highlight that here shortly. But before we do, I'm just going to highlight the key reasons why I really like HBank through Horizon. Now, if you're say nearing retirement and you're probably looking to have the most simplest dividend portfolio, maybe you're not wanting to have to look at the individual banks. There's primarily 6 of them to consider, and so this nice ETF, one symbol to buy, and you get all the major 6 banks, right? Now, the other thing that is really important to me, and this is just a personal preference, is I really like the monthly dividends, whereas compared to if you were to invest directly into the banks, you're looking at quarterly dividend payments. Now, there's nothing wrong with that. It's not like you get less money or anything like that. I just like the monthly income versus the quarterly. That's a personal preference of mine. Let me know in the comments what you guys think about that. But like I said, equal weight, you can see between Toronto, Royal Bank, National, Bank of Nova Scotia, BMO, they're all around that 16%, give or take a couple basis points, right? So again, equal weight, you buy one ETF and you get the 6 individual Canadian banks. Now, I did highlight on the reliability of the dividends. Now, looking at say something like TD Canada Trust, I can't remember the exact numbers. I did a YouTube short video on TD that went over the dividend history of TD, and they paid something like 156 years of dividends, and like the last 70 of them or something like that has been increased year after year. So you can just kind of see, from 2014, they were starting at around 22 cents per share for dividends, and it slowly and steadily has now increased to $1.02. So again, when you're getting into a dividend portfolio, I think it's really important to make sure that your dividends has the potential to grow, right? Because you don't want to say start with like a $12,000 annual dividend portfolio and it stays at $12,000 for the next 10 years, because let's face it, inflation is going to erode your buying power, right? So same thing with like Royal Bank. You can see again, they back in 2014 they were paying 67 cents, and as of today they're paying $1.38. Again, they paid a large number of years of dividends, as well as having those increase year after year. Same thing with Scotia Bank, starting at 62 cents and increasing all the way to $1.06. So these are just like the biggest reasons why I feel that it's important to have dividend or a banking sector from Canada in your dividend portfolio. Now, if this is a non-registered account, it's also good to highlight that these are paid out in eligible dividends. Now, I'm not going to get into what eligible dividends is, but it does give you a bit of a tax break as well when living on these types of dividends. So that's something to kind of Google to get a little bit more information on for your guys' selves. So that's why, like I said, I have 20% of Horizon's equal weight bank ETF, and it works out to be about 3.2% in each bank. And if you're familiar with the channel, I've talked about it a number of times before, that I usually recommend no more than 5% in any single stock, as well as no more than 20% in any single sector. Now, that is a rule of thumb. Sometimes it doesn't exactly line up like that, but that's just something to kind of aim for, right? Now, getting into the next one, this one's going to be controversial. Now, I put it in the portfolio. Let me know what you guys think, but I did 30% into a bond ETF known as ZAG. Now, I know that people aren't necessarily loving on bonds right now, but I do feel it's an asset class that you should include in a diversified portfolio. Now, especially if you're, in the era of retiring. Now, myself, I only have like 10% into ZAG in my overall portfolio, which isn't a lot, but I am only 34 years old. So if you are nearing retirement, it is good. Now, 30% is a little low, and you're going to see why I've done that once we get through the other blocked off ticker symbols here. But it does pay a 3.57 dividend. So again, I actually don't have anything specifically to highlight about ZAG. It is just a bond ETF, but it is paying 3.57% annually. So getting into the next one. The next one is XEQT. Now, if you're familiar with the channel, you're going to know that XEQT is a fan favorite of mine. It is part of my core portfolio that I have here that I show on this YouTube channel. Now, the reasoning why I've allocated 20% to XEQT is because this is the growth portion of the portfolio, right? So now we could, not do this and we just focus more on high-paying ETFs or individual stocks, but it does increase risk because then there's the chance of that portfolio eroding away. So I do feel it's important to include some sort of growth vector. You could substitute this. You could say, I'm just going to go into like the US market only. I specifically chose XEQT because it is obviously a diversified portfolio. Now, for those of you who aren't familiar with XEQT, it is an all-in-one ETF. So this particular ETF holds over 9,000 different stocks or equities, whatever you want to refer to them as. You can see here on the exposure breakdown that it is primarily in the US. But there is some more in the Canadian economy as well as the remaining international locations. So going back to our Excel sheet. So what's next? So we have the Horizon Bank ETF, which is going to primarily contribute to the dividends. We have bonds, which again contributing to that dividends because it's a fixed income asset. We have XEQT as our growth sector within the portfolio. The next one, again, this one is kind of optional, and I feel you could do this one or add more to bonds. And we're going to highlight the differences a little bit later on this video and what that does. But it's PSA, which is a high interest savings ETF. Now, you guys might not be familiar with these, but this is, like I said, a high interest savings ETF. And basically what it does is it starts at $50 every month. And then as the interest accumulates in the ETF, which you can see right now, it's at $50.13. So at the end of each month, it pays out that interest and brings it right back down to $50. You can see how it does that every single month over the last 5 years, right? So the downfall with this one is that it's paying out roughly, let's see here, 4.5%, but it's temporary, right? This PSA ETF is not going to be always paying that, because once the Bank of Canada starts lowering the the Bank of Canada interest rates, this is going to come down. So part of me is hesitant about if I would actually do this or if I would actually take that a 20% allocation and actually add it into the bond, because once interest rates start coming down, the bond ETF fund is going to go up in value. So it's going to provide that growth in the ETF itself. Now, later on in this video, I'm going to just quickly highlight on the differences that it makes. So stay tuned for that. But like I said, this one I'm not exactly sure of. I did still put it in there, but it's questionable. So moving into the next guy, this is MREL, which is an ETF for real estate. Now, you could go into specifically like a RioCan or a Smart Centers within Canada, but if you're familiar with my style, I really like diversification. Now, if you look at this particular ETF, which is primarily focused on real estate, it's in a number of different sectors within the real estate areas, right? So you got Boardwalk REIT, you got RioCan, which is obviously a fan favorite here on the channel, and I invest in that in my RSP. You got the Canadian Apartment REIT, which has been doing substantially well lately, just because, of course, of the high costs of everything and people actually needing to live in more apartments nowadays compared to just purchased housing. So the nice thing is this is the breakdown of the different sectors within the real estate, which is really kind of nice, as well as it is international. So it is primarily in Canada, but 20% of it is also in the US, and then a very, very small portion of it being in the international sector. So I really kind of like this one. It does pay out a pretty healthy dividend as well. Right now it's paying at 7.5%, and over the last 10 years it has gone up 6.5%. Now, so I really do feel that like this, if you were to compare like the individual REITs within Canada or go right into the Middlefield ETF, this one has performed the best. Now, I know that past performance isn't always the way to base things off of, but again, basing it off of diversification and not putting ourselves into like one sector in real estate. So like if you were to go into say RioCan, that guy is primarily into like retail and office REITs. Now they are getting into residential and all that kind of stuff, but this one is just like diversification on steroids, which is why I chose that. And like I said, it did pay out a pretty nice dividend, which again is still monthly, but at 7.5%. So that's the reason why I chose this guy. Next one on the list we will uncover here, and this one is Enbridge. Now this is like the one individual stock that I had chosen. I just feel that it is very consistent and very safe. Now, if you are familiar with my channel, you probably have saw my Enbridge videos. I have 2 of them out already. Again, they've paid out like 29 years of, they've paid out 70 years of dividends. They've also increased their dividends the last 29 times consecutively, and they're averaging anywhere between 3 to 5.5% dividend growth year after year. So again, like I had mentioned, which is really important to have dividends growing within your portfolio. So you can see Enbridge was paying out 32 cents in 2014 and now paying out 68 cents in 2024. So again, it's doubled its dividends in the last 10 years. And also to the actual stock appreciation or the cap or the stock price itself seems to be kind of consistent. Like it does go down to mid 40s, it goes close to 50s. But again, we're not necessarily looking for like direct capital appreciation. We're looking for reliable dividends, and I do feel that this one will level out the portfolio. Let me know in the comments below if you feel this is the right move or not. But again, this is what I would be doing if I was building the portfolio today. So getting into now the performance of this portfolio. So I have done a back test on this portfolio, and this is again from 2014 to 2024. The $300,000, we are not reinvesting the dividends, and we will be displaying the income. So I had to get a little creative on the portfolio because HBNK is a brand new ETF, so it wasn't around in 2014. So I actually did have to put the individual banks individually. So you can see here the 3.2%, like I had mentioned earlier, that it works out to be. And then everything else, also too, XEQT was not around in 2014, so I had to take the underlying assets that it has and also build in, it's only 20%, so these are what the figures worked out to be. So looking at the actual performance of it itself, starting at, let's say in 2014, we started with $300,000. Over the course of 10 years, it has grown to $391,000 for a compound annual growth rate of 2.65%. So if you remember at the earlier point of this video, I mentioned how my goal would be to have 1 to 2% capital appreciation. So this particular portfolio has grown in the last 10 years 2.65. So looking at the annual income, so starting out obviously right now it is at $10,000 back in 2014, and it would be paying out now $14,500 in 2020, or it paid out $14,500 in 2023. So you can see how, like I mentioned, the dividends is growing over time. So, you know, to try to keep up with that inflation and not erode away your actual dividend income. So I did mention how the PSA ETF was somewhat of an option. So I do just want to make that slight change here. And so we're going to just zero this out back to 0% and move this guy to 50%. And by doing this, you'll actually see the portfolio actually grew less. You know, when you think of the PSA.TO, the amount that it's paying out right now has definitely increased the compound annual growth rate because of how much it's done with the interest rates as of late, right? So the portfolio is still up. It's at 385,000 compared to the, I think it was 395 or something like that on the last guy. But one thing that I wanted to point out is I feel that the income was more leveled out, right? So when you compared the other one, it seemed like it had a little bit more blips in the income. And that's because, again, PSA is very combined with the Bank of the interest rates from Canada. So with the ZEG portfolio now being 50% of the portfolio instead of 30, that one just consistently pays out a certain amount of dividends each month. So again, like I said, it levels it out ever so slightly. So with the interest rates expected to come down in the near future, you know, whether that's this year or next, it could be a better play to put more money into bonds. So that's just kind of something I wanted to highlight. So now I want to just take a little bit of time and talk about time in the market, because if you're looking to invest into a dividend portfolio, there is obviously that scenario where it's like, well, I'd rather go into GICs because they're safer and they're guaranteed, which is fine. There's nothing wrong with that. But obviously that if you're getting 4% on a GIC right now, once those expire, you know, in a couple of years from now, you're probably not going to be getting that anymore. So then what do you do, right? So this particular style of investing, if you're looking to make money, to make more of a dividend income, whether it's through GICs or the dividend portfolio, I do feel that the dividend portfolio is more suited long-term versus the GICs being more short-term, right? So now I want to talk about the time in the market, because time in the market does reduce risk on a portfolio. So I'm going to just kind of show you guys here. We're going to have three different portfolios, one being 100% equities and 0% bonds. We're going to have 80% equities and 20% bonds, and 60% equities and 40% bonds. And now this particular portfolio that we're going to be comparing is the US total stock market, the global, so this is an international minusing out the US, and then of course the bond market. So you can see here under the 100% equities, we had 40% of the US market, and 55% being the international, and 0% being bonds, and so on and so forth, okay? So going into what this means. So obviously I want to highlight some of the data that I gathered. So from like 1990, you can see, you know, negative 16% on the 100% equities and only negative 6.36 on the 60-40 portfolio, right? So these are just some key dates to kind of look at. So you can see in 2008, you know, it dropped 40% on the 100% equity portfolio, and this is the 2008 stock market crash, you know, and the 60-40 portfolio only dropped 22%. So going into this, I just kind of want to highlight how time in the market reduces risk. So again, that stock market crash being the worst year of the US stock market, being a negative 40% in that given year. Now, when you look at the 5-year, if you were invested for 5 years, this includes that 2008 year where it dropped 40%. But you can see 40 years, you only lost 1.95% on your portfolio, which is not anywhere close to negative 40%. And if you were invested for 10 years, you actually gained 0.76, right? So this is just what I'm trying to show is that, so this is based on the worst returns annualized from 1988 to 2023. So if you were looking to build a dividend portfolio, this is what you could expect when you have time on your side, right? And then going into the best returns, you have, the 1 year being a positive 36% and averaging out over 10 years across the board, 11.52, 10.68, and 10.06. So again, I just want to highlight how time in the market reduces risk. So I hope you guys found that helpful. Definitely hit the subscribe button. I am planning on doing this exact video, but also with a US currency and US ticker symbols instead of it being primarily from Canada. I know lots of expats or people that are retired or living, primarily in the United States. So maybe they have more US money than they do actually Canadian money. So I'm going to be doing that one as well. And if you haven't checked out my latest reason as to why, or my latest video as to why I added Tech.to to my portfolio, definitely check that out. And I hope you guys enjoyed this, and we'll see you guys next time.